Hello, today is August 22, 2023, and it's time for some new stock picks. As always, I'll review the performance of my picks from this time last year, talk about the current market conditions, and give a little bit of an analysis and give you some new stock picks for the next 12 months and beyond. So this time last year, I picked a grocery chain, a Dutch European chain that has lots of operation in the US. It's a hard to pronounce name. Symbol ADRNY. The stock was up 23.5% in the last 12 months in US dollars, including dividends. Then Landstar Systems, symbol LSTR, an industrial company. The stock was up 26.6%. And Canadian Utilities, a Canadian utility company from Alberta, the stock was down 21.4% in US dollars, including dividends, for an average of 9.6%. Which compares with 8.4% for the MSCI World Equity Index in US dollars, including dividends. And once again, our picks outperformed the market, despite a little bit this time. But on average, in the 3 years or so that we've been doing this, my picks have outperformed the market by 6.1%, and they outperformed 76% of the time, for an average 1-year return of 11% compared to an average 1-year return for the market of 4.9%. The last 12 months or so have been quite interesting. We've had a war happening with Russia and Ukraine. We had inflation. We had central banks raising rates. We had stocks go down a fair bit from the summer of last year to October of last year, and then they kind of slowly inched up since then. We've had a yield curve that's been inverted since the fall of last year. That means the short-term interest rates have been higher than the longer-term interest rates, and historically, when that happens, the economy slows down in the 12 to 18 months afterwards, as availability of credit declines, as banks borrow on the short end of the curve and lend on the 5-year or longer term. And because the profit margins are lower, they don't want to lend out as much. Also, with rates being higher, borrowers don't want to borrow as much. So with less borrowing, that leads to lower economic activity, which most of the time leads to a recession, which is not necessarily that good for us equity investors. So this recession hasn't happened yet, and we think that's due to excess liquidity from the monetary and fiscal stimuli that happened since COVID. The governments around the world, the central banks, and the various governments, the US, Canada, others have introduced various stimulus packages, and there is excess liquidity still in the system, and that's why the economy has been strong despite the higher interest rates. With that in mind, it probably just means that a slowdown of some kind is coming sooner rather than later. And additionally, valuations for stocks are still fairly high, so which makes investing in equities not particularly attractive at this point, especially when there are other alternatives, such as investing in short-term bonds at over 5%, GICs at over 5%, corporate bonds at even higher numbers than that. Not the best time to go heavily invested in the markets, but having said that, it's always a good idea to have exposure to equities, because timing the equities market is really hard. So we tend not to try to do it too much. For the next 12 months, I picked 3 kind of stable companies with expected volatility in the stock price that's a little bit lower than average, just in case we do have a correction in the market, and valuations that are more reasonable than the market, and hopefully we have a better return than the market in the next 12 months and beyond. First one is a utility company, and I actually have 2 utility companies as either or as a pick. For non-registered accounts, I have a UK stock. For registered accounts, I have a UK stock, and for non-registered accounts, I have a Canadian utility company, because the dividends from the Canadian companies are preferentially taxed for non-registered accounts. So for non-registered accounts, we'd want to own the Canadian company. For registered accounts, we want to own the UK company. The UK company is National Grid. National Grid owns and operates the electric transmission system in England and Wales. It has a pretty stable business, a stable return on equity. Valuation is reasonable. It pays a 5.5% dividend, and we expect a total return in the high single-digit number from the stock, and most of it is going to come in the form of a dividend at 5.5%. So that's pick number 1 for registered accounts. For non-registered accounts, Fortis, symbol FTS on the TSX. Fortis owns and operates 8 utility transmission and distribution subsidiaries in Canada and the United States. Stock is, again, a very stable type company. Valuation is not particularly good, but it's not bad either. And we are getting about 4.25% dividend on this, and expected return in the total return in the 7 to 8% range. So it's not huge, but it's something to have in a well-diversified portfolio. The second pick that I have today is an industrial company called Ennis in the US, ticker symbol EBF. It is a manufacturer and supplier of print products for the wholesale trade. It's got a decent return on equity, a decent valuation, a good dividend yield, about 4.7%, and like I said, the stock is very stable, even though the business is a little bit cyclical. If we go into recession, the business may decline, but historically it's done okay, even in kind of a tougher economic environment. And the third pick is a Japanese non-life insurance company, MSCI Insurance Group Holdings, symbol MSADY. They're the second largest non-life insurance company in Japan. The theme is still the same: stable profitability, stable company, stable balance sheet, decent valuation, and a decent dividend yield of about 4%. As always, if you'd like a second opinion as to how these stocks fit in your hopefully already otherwise well-diversified portfolio, or if you have any other investment questions, please don't hesitate to give us a call. Thank you and have a great day.